Resource Watch is brought to you in association with Thebe Investment Corporation.
Hello. On the show today, we are unpacking a deal which sees Thebe Resources increase its stake in petroleum giant Shell. I'm Kukuletu Tsele. Welcome to Resource Watch. Let's kick off with the market wrap for this week.
South Africa's Minerals Minister Nwako Ramatlodi wants to see laws on oil and gas exploration be separated from mining legislation. His comments come as changes to the 2002 Mineral and Petroleum Resources Development Amendment Bill have been referred back to Parliament on the grounds that it might violate the Constitution. Oil and gas explorers have been critical of provisions in the bill, saying it creates uncertainty and undermines business. The world's largest mining company, BHP Billiton, says group production is up 9%. CEO Andrew Mackenzie described its operational performance as strong over the last 6 months, saying BHP is reducing costs and improving operational productivity to mitigate the impact of lower commodity prices. The Harare-based Chamber of Mines says Zimbabwe's gold mining firms are making losses due to weak bullion prices and could collapse unless the government reduces royalties. Gold is the single largest export earner in the southern African country, whose economy has been in the doldrums for over a decade. The chamber wants royalties to be reduced to 3%, down from the current 5%.
28%. That's how much Thebe Resources now owns of Shell, a partnership stretching over 10 years. It's a deal valued at billions of rands and is the largest single investment in the Thebe portfolio. For all the details, I'm now joined by Thebe Investment Corporation Chairman Vusi Khanyile. Thank you so much for joining us today, sir. Maybe if you can take us back into the deal and why it was necessary.
Well, let me say Shell has had two businesses in South Africa. One was the marketing business, which takes product from the refinery to all the markets, be they retail, commercial, aviation, or shipping. All the markets you can think of. The second business then was the refinery. There were two separate businesses, and Thebe was a shareholder in both. So what has happened with this transaction then is that the two businesses are going to merge. But as part of the merger, Thebe is going to increase its shareholding on the refinery side to 28%.
What kind of value does this unlock for Thebe in particular?
Well, we took the view that we're not going to release the figures, but clearly, without doubt, the merged business will be much stronger than the two separate businesses. So from a balance sheet perspective, it will be a lot more stronger. Because we take the view that there's a lot that needs to be done. You need further investments into infrastructure and those sort of things. So a stronger balance sheet is always welcome.
It is always welcome, especially because you want to increase your presence in the oil and gas opportunities on the African continent. What do you make about the opportunities that are presented there, and how are you hoping to capitalize on them?
Well, a little while ago, about 10 years ago, we identified the fuel sector as the sector that will fuel our future as Thebe. But the way it's turning out, it looks like it's going to fuel the future of the country, South Africa, that is. Our investment portfolio is very much anchored on the oil and gas sector, and therefore cleaning up our relationship with Shell and having the opportunity to redefine the relationship in the context of what needs to be done out there, I think was actually the best thing for us that we could do at this time.
Now, there are a lot of macroeconomic factors that do play quite a strong influence on the oil and gas sector. We recently saw the significant fall in the oil price as well as the slump in the commodity cycle overall. Is that a concern for you, or does it alert you to working in that business more wisely? In other words, cost efficiencies to ensure that whatever market volatilities take place don't really impact the bottom line?
Luckily, the oil price whatever happens with the oil price now, does not affect the deal as such. but it is the margins, the difference between the input cost and the output cost, the crude and the product price. And nobody controls that. So with the price coming down, we are not worse off than we were before. But the macro factors really that you are referring to, in my view, in South Africa at least, is the growth of the sector, with the mobility of the people and the transformation that is going on. There is just a much bigger need for product, both oil as well as gas products, and we would like to position ourselves to be a player.
What about the policies that have currently been in place? And I say that because we recently had news about the Mineral Resources and Petroleum Development Act being sent back to Parliament by President Jacob Zuma. Your thoughts on that development?
Well, there is a sense in which some commentators are showing disappointment with the pulling back of the act and sending it back to the drawing board. But frankly, I take the view that we would rather come out with a law that is robust, that is sustainable, that has been tested, and everybody is comfortable that it addresses all the requirements such as growth and such as equity within the country, and that it drives transformation and changes in our country. So I'd rather have it 6 months later than too soon.
Coming back to your relationship with Shell, which spans over 10 years, what do you make of the empowerment landscape in South Africa and the progress that's been made so far?
Well, it's actually 12 years. We started the relationship with Shell 12 years, and it was not an equity relationship. At the time, we had our own business that we were running, that we owned 85%, and we controlled it. And we had a commercial relationship with Shell. And then because of the success of that commercial relationship, we ended up escalating that to an equity level. But I won't single Shell out here alone. South Africa is transforming. Transformation is the objective of this part of the world, to make people more equitable, especially across races and across gender. Has there been enough of that transformation in the petroleum sector, in the oil and gas sector? Clearly not. And I think that's partly what the legislation is trying to address. But in fulfillment of time, we believe that there will be appropriate transformation, and whatever we're doing with Shell is simply a modest contribution in that regard.
How do we ensure that it's sustainable? Because I think that's also a common theme that comes across when it comes to empowerment deals, that it's often viewed as a once-off. It benefits those who are in the right positions, and it doesn't really filter through to the bottom end of the scale.
Well, that's where then the regulations come in. Fortunately, luckily, the industry is not self-regulating. Government as a regulator has got that mandate to make sure that the laws that are in the country, the rules that define the economic game, must benefit everybody. There's got to be sunshine for everyone in our country.
What about the thoughts on talent? Is that also maybe another challenge that we're experiencing here in South Africa? The slow growth, high unemployment rate, a lack of educated and required skills and services necessary for the oil and gas sector?
That is true, for the gas sector in particular, because it's a new industry, but skills can be developed.
How is Thebe working towards assisting in that role?
I would like to expect that companies that wish to play a role in this sector are already busy developing their people, acquiring resources that give them a competitive edge. This is the time to prepare for the gas era in South Africa. This is the time to prepare for the upstream era, because when ultimately the drilling starts, it will be too late.
That's a very sharp note to leave it on, but just to close off with your points on the relationship between government, business as well as labor, is it a conversation that still needs to get ongoing and implementation with regard to changes that need to take place?
It's a difficult relationship because they represent different interests, especially business and labor. And government has got its hands full trying to manage this tripartite relationship. And without that, South Africa will not survive.
Mr. Khanyile, thank you so much for your time today. Such a pleasure speaking to you.
You're welcome.
With the recent global oil price plunge, our gem of the week looks at the winners and losers of a sustained low oil price.
With the global oil price under $50 a barrel, it's great news for consumers, but not so for oil-producing nations. Why is the oil price so volatile?
More sellers than buyers. This is the foundation of it, and it sounds simple, but that is it. I think what we have to say is that previously the biggest user and the biggest importer of oil in the world was the US. However, in the last few years, they have gone towards being self-sufficient in energy production. The second biggest user, China, is now the biggest importer. Their rate of growth is slowing. It was growing, remember, just a few years ago at 11 to 12%. Wow, extraordinary. Now it's growing at 7%, only 7%. Heck, if we could get halfway there, we'd be pleased with ourselves. But it still is a much lower, it's going to mean a much lower consumption of oil, the driving force of their industry.
Added to this, OPEC is determined not to cut production to prop up prices. So who are the winners and losers? Globally, Russia is one of the world's largest oil producers. For every dollar fall in the oil price, it loses about $2 billion in revenue. Saudi Arabia needs oil prices to be around $85 in the long term, but it has deep pockets with a reserve fund of some $700 billion, so it can withstand lower prices for some time. Africa is a different story altogether. There are obvious beneficiaries, the non-oil producers, mainly in southern and East Africa. South Africa will benefit from the price drop, mainly in manufacturing, agriculture, mining and the transport industry. And consumers who will save at the pumps will have a little extra to spend. Meanwhile, East Africa and its emerging oil discoveries, both offshore and onshore, will be greatly slowed down, if not scuttled altogether. We know that the situation in West Africa is rather dire. That's where the majority of Africa's oil producers are found. Nigeria has already been hit hard. The naira has been the continent's worst performing currency, depreciating nearly 16% in the past 3 months, despite a rise in interest rates in November and spending cuts to the 2015 budget. So is this the bottom for the oil price?
Remember, it's been coming down from 120, even higher than that, over the last couple of years. So we can't expect it to drift down and suddenly shoot up. No, I think we've got to go through the bottom of this trend and in due course maybe inch up a little at a time as demand builds up, and with the overall state of the world economy being relatively subdued, we're not going to see a very fast pickup in new energy demand.
Well, that's it for this week's show. Do stay in touch. You can follow me on Twitter @Gukumfupi or use our hashtag. It's #ResourceWatch. Until next time, it's goodbye for now.